It's me Pavitran here. Today we're going to do a weekly forecast of crude oil and how price is going to react to the coming levels, which I'm going to mention. And before going that, we're going to see how crude oil behaved last week and what had happened and what are the levels it has been respecting. It's nothing but I said the same strategies, sell on rise until 43.50 is taken out, and as you can see the 43.50 level is still intact. And as you can see, on a Friday a sharp sell-off has happened, and I have marked this zone somewhere which had started long back, somewhere nearly we'll just zoom it down and I'll show you. So this is the region. So this is a huge sell-off. The origin of this region, origin of this rally is somewhere around here. So I mark this region. So until this region is taken out, that is 42 is taken out, then we won't be seeing 43.50 in a quite long time. And as usual, a huge buy has taken place here, and this has been no follow through sell. So this region is still quite intact, and we will see only a sharp fall only when this region is taken out. So what are the levels that we should be keeping in mind while trading crude oil in coming week is that just for a bigger range, 42 and 46, that is a $6 range. And if you go in for a smaller range, then this range will be quite useful for you, 42 and 39. Only when this range broken, then the odds of testing either 43 and 36 is more. Until and unless this both region is not being tested, then it's not being broken, then we won't be seeing such a huge rally either on a top side or a bottom side. So this is just ranges where you should be playing your option strategies, which might come in handy. So for example, if you had initiated a position on Monday, say price has been hovering around this range of 40. So as you know, this is an resistance and this is a support. So if you have taken a strangle, then the whole week has been kept in a sideways. So you can eat some of the premiums for the week. There has been much movement on either side. Whenever price tries to come near this region, you can take support over this region, and you should exit your position only when this region gets taken out. So there's 39 is taken out, then you should exit your position, and a similar way on 42 is taken out, then you should exit your short. So you can either place a short over this region whenever price enters in the region. Don't worry about the candlesticks, just enter a short trade, have a stop loss just above this region 42. So what should be your target is maybe your stop loss is somewhere around 60 cents. So you should aim for this below region, that is 39.5 to 39, whatever if you feel comfortable, and that is nearly somewhere around $2. So we don't know when actually our target is going to be met. It can stay in sideways for 2 to 3 days, it's kind of a swing trade. We are just playing with the ranges. Whenever price enters, you can short, this is your stop loss and this is your target. Whenever price comes near this region, you can either buy with below this zone as a stop loss, and your target should be this zone. So you're either way playing with the zone. If the zone gets broken, then you can again short with the target as this, and stop loss is the previous zone high. So small stop loss and somewhere around big targets, that is nearly 1:4, 1:5 will be the range you will be getting. And still, if you are not happy with this 1:4 or 1:5 ranges, then you can just go for even bigger ranges. Even bigger ranges in the sense, let me show you the previous results of this. I was just testing it out. So this is the place where the initial setup has came, and After this sell off, the zone has been created, and after this fall, okay, if you after this consolidation and market rallied up, this buying zone. So whenever market is trying to come and test this region, you can just buy, which is stop loss is just below $36. So somewhere around 60 to 80 cents maybe will be a stop loss. And what's your target is the zone high. So you should place somewhere around 37 to 41. That's nearly a $4 over, with your stop loss as one maybe 80 to 40 cents depending upon the candle low which is you're going to enter. We don't know when exactly our target is going to be met, but we should keep holding on to a we have to keep on riding this. In between you will get a sharp dip, in between you will get a sharp buy, and sell off might come. It can stay in this ranges for 3 to 4 days. So for example, if you have taken if the zone has been formed after this, we are seeing that 36 has been not traded, 36 hasn't been broken. So we are expecting this to hover around this range. We will be so much bearish only when 36 is taken out. So what we should do is, say for example, we have initiated a trade over here or over here. Just consider this an example I'm just giving. You have initiated a trade here, and our stop loss is 36. That is somewhere around, it's a $1 stop loss for us. We don't know when it's going to trade. So if you even a drawn a trend line over this region, it's still a bearish one, and it is given a break over here. So if it is given a break over here, then you can even pyramid your position, because this sell or this kind of a trend line breaks, it's again confirmation for you that bear channel is getting broken and we are in for a bull ride. So this is a target. So in the meantime, you can see a sharp dip, again a rise, again consolidation, again a rise, again a sideways consolidation, again a rise, sideways consolidation, and a dip, and again a rise and again a dip. We don't know how or how long we are going to take to reach a target of 41.5 or 41. It's up to you whether you can either exit your position here or you can enter your position here. You can, we don't know when our target is going to be met. Similarly, and after this huge region has formed a huge, the person who have shorted this region will try to defend the position. Once tries comes into the region, short it, and with the 42 as a stop loss. You can either keep your stop loss on a closing basis, or just keep your stop loss on for intraday basis. If it's touches or price comes near this, it can take your stop loss. It's based on you, and how long can you able to handle your trades on based on the risk you're going to put in into trade. And finally, it's up to you, it's up to your trading decision, and it's up to your capacity on how you're going to handle and how you're going to manage that. So we still don't know how this is going to play out, on how long it's going to take for us to reach a target, but we know the ranges for sure. And the ranges is, once price comes in this region, the next target for downside is this, and if this breaks, then again we should be looking forward to going for a good break above, and the target is 43.50. So either you, if you have shorted here, see how long it has taken for a target to maybe met. Say you have shorted at 18th of September. See, on 2nd of October, the target has been met. In between those times, you can see the dip price, dip price, dip price, dip price. We don't know how long our targets is going to make. It can either take a 1 month of consolidation period, it can either take maybe 2 to 3 weeks, and even it can take just a 1 day. We don't know how this is going to play out, but the only thing you should be very much comfortable is that your risk reward ratio. Say for example, if you enter the trade here, the moment it touches the zone, that is 41.30, if you have initiated the trade, 70 cents as your stop loss. So from 41.30 you have reached 37. So that's nearly, and again, a $4 rally. So your maybe somewhere around 1 is to 6 or 1 is to 5 ratio, you will be getting a profit, good profits. But the thing is that you have to hold on for quite a while. You can even do an intraday, and the intraday has been done, or you can do intraday. uh, Maybe try to take a short position when price tries to come in this region, and switch time frames to maybe 15 minutes or 5 minutes, and whenever you find a good opportunity and a bearish candlesticks pattern, then you can short it over here. And after this, again, if you have initiated the position, so this is our target. So on 2nd of September we have initiated the trade, and it has achieved on 9th of October. So uh, we have got 3 quality trades, but in the span of nearly 1.5 months. The time period between each trade depends, and we might not reach, maybe even for a month we won't be getting some trades, because it will be in a consolidation range. So what we are doing is that we are trying to play out, or we are trying to maximize, or we are trying to stretch out the zones. So basically what we are trying to find is that in a coming week or in a coming month, say for example after the zone is getting formed, unless and until 42 or 36 gets broken, then we will be hovering in the same zone for as long as the price stays between that zone. Maybe you can initiate a strangle at 42 and 36, collect whatever premiums that is been provided by these two strangle and options. And if you don't know much deep about options, then you can either sell future and you have to hold on. uh, Maybe in the meantime, what had happened over this region on 5th of October, it has created, or we have drawn another zone that has been respecting this. So after this further rally, and a sudden buying pressure has came, so origin of this rally has occurred. And after that, see, as usual, price comes in this region, it lowers the stop loss, and it actually go and test this region. You're shorting here, price comes down, you're going long again, then hovering in this range, and it's going near this range. And if you're shorted here, you comes down again. If it comes down, you're going long here, again it goes up. So it's basically a thing that you don't know where, how and when, but price usually reacting to these zones. Your stop loss is very much less, and you can initiate a trade. You can just hold with the small stop loss, and you can try the big ones. This is the zones, or this is the level you should be watching out for coming week 2. And the big questions for, if this breaks 42, then 43. Why 43.5 is because, like I said, just a reason. The basic reason is, this is the reason. It has been rejected here, rejected here, rejected here, rejected here. So 43.50 will act as a crucial resistance zones. Once 42 is taken out, then 43.50 will be on the cards. Until and unless 36 is being taken out, we won't be seeing much of a fall. So price can hover in this zone for still 2 to 3 weeks, if this price will be intact in this region, until and unless we get a good break of 42 or a good break below 36, though we won't be seeing much of a fall. What you can do is, if you have a patient to hold for maybe 10 days or 20 days in a futures contract, if you don't want to trade continuously, you don't want to scratch your heads for intraday purposes, then you can actually go for this kind of a trading style. So you'll be getting monthly one trade maximum you will be getting, and this is based on the simple setup is based on 1 hour time frame. So on a 1 hour time frame, you have to find out the origin of the rally. See, this is the origin of the rally, and this till this region is taken out, price will be hovering. So this is the origin of the rally for this entire move. So price has started retracing, and the price has not able to break this low or break this fall low. There has been no follow through. So until this region is intact, and see how the price has been reacting to this range. So big players who have entered here at 42, and the big player who has stopped the fall at 36, as you can see from 7th of maybe on 4th of September, they are keeping the crude oil price between 42 and 36 for a period of nearly 1.5 months. So you might have got literally 2 to 3 trades. Even if you have missed this, no problem. And even if you have missed this rally, no problem. The moment the price enters from here, you'd have got one trade, and from here you'd have got another trade. So what I'm basically trying to say is, monthly one trade is good enough for you. 1:4, 1:4, or 1:5 ratios. You are entering here, you are exiting here. You are entering here, you are exiting here. So it's you have got nearly one and two trades. And the moment price comes in this region, you are expecting a price to come below this. So we are in the third trade right now, and after seeing a quite a bit of consolidation, you can either book here, or you can either take a good another position here. You can book it out, and one price tries to come in. So basically you have got 5 quality trades from the last maybe 5 to 6 sessions, or maybe 5 to 6 weeks. And 1.5 weeks you have got quality of 5 trades with a minimal stop loss with maximum profit. So none of this have hit the stop loss, and for every sorry about that, for every targets it's nearly for every targets it's nearly 1:4 ratios. So what I'm trying to say is, you have gotten somewhere around 5 trades, and for each one consider this as it has written the target of $4, and from here again a $4, and from here you have initiated the position, assuming this as you have taken support. You are trying to end your position maybe somewhere around it's nearly again a $2, from here again a $2. So nearly you have booked 12 to 13 or $14 in place. So what more you want on if you have initiated if you have increased your lot size on each of these trades, then it will be much more easy for you to trade only these 4 setups, and you would have got nearly and 100 into 10 to 2, that is 1000 to maybe 1000 or $2000 in your pockets without any of without much struggle. So only thing how to do is you have to hold the moment when your stop loss triggered, switch and reverse for the position. Simple. They same. What is the maximum stop you are going to get? It's pretty much the same. That's only $1 rupees you are going to take a risk. If on an intraday basis, it will be quite a tricky one, but on a positional basis, I think the swing will really help you, and the range will give you a better clarity of how the price has been kept in the range for longer period of time, and how the ranges has been determined. um, if you have, if you want on a still a larger perspective, you can just go in and switch your time frame to 4 hours, and you can just find out the origin of the rally and mark this region. The moment the price steps into that region, it will be respected perfectly. You don't have to worry about the inventories, you don't have to worry about any of the crashes, you don't have to worry about Trump tweets, you don't have to forecast, you don't have to do anything. You just have to sit and wait for a target or either SL. So even if a 4 trades goes against you, no problem. And the moment you take the fifth one, you will be on back to be cost to cost, because your risk reward is that much better. It's so much better that we can hit your stop loss for nearly 10 to 20 times, and the moment only 1 to 2 trades goes in your favor, then every loss will be coming back to you. So just you will be only one trade away from taking this huge position, or you will be only one trade away. So this is the range you should be watching out for. And 42 should be taken out, and 36 has to be taken out. Until then we will be hovering in this range. Then just intermediate range has been formed, and once that ranges, if you want, you can even take that range also into consideration. Maybe it's just 50 cents as a stop loss. The moment price tries to come near this range, um, you can take a buy position with the stop loss as 39, and target as usual, but you have to hold for it. For target as usual is 41.30 to 42. We exactly don't know whether it is going to touch 42. It's better to sell when it comes near or below this range. We don't have to exactly wait for 41.30. It's better we should square it off at 41.20 to 41 to, that's $20 cents. So why I'm saying this, see, if you can see exactly at the 15th of October, the price tried to come near that range. So see here, it has given a little bit of resistance, and the sellers started to come in. After that, there is no looking back. So it's just missed the target, some of gap of 4 to 5 cents. So we can't be exactly looking at 41.30. You don't have to expect that the price has to come to 41.30. It can even go back from 41.20. So it's okay if you are following it continuously. The moment price tries to come near this region, have a stop loss between the candles, and if it's taken out, then well and good. Initiate an exact reverse entry to that and sit tight for another either for a sell or for a target. So in this range, if you keep on playing well, then one or two or three, four quality trades is more than sufficient for you to, will be more than enough for you to trade continuously, and you can be profitable for a whole month. You just don't have to looking for a lot of data. You don't have to keep on continuously watching the screens. There is no things like that. It's a kind of a swing, and it's pretty much will be useful for positional traders. You will be having a stop loss in handy. It will surely help you. The moment the stop loss triggered, go in for a reverse trade. The moment stop loss triggered here, you have to go in for reverse trade with target. You know the target and you know your stop losses. Just don't do average or don't do hope trading, because the moment this 42 will taken out, you can't expect price to go there 42 on 43. So some will think that it can take resistance here, it can be a fake breakout. No, we can't assume anything. What is our system saying is that the moment 42 is broken with a good volume, then what is the next region? 43.5. So you should not be thinking that you have taken a trade, I won't be able to accept loss, I will wait for price to come near, I will again short here and I will cover my losses. No, that is the wrong way of doing trades. You have to accept your losses, because why I am saying is that it's just a matter of 50 to 60 cents as stop loss. The moment 42 is crossed, your stop losses keep on getting increase, and the moment it reaches 42.50, that it's nearly somewhere around $2 stop loss. So for each lot you're carrying a stop loss of $2, and with the price comes near this region, you are going to again short here. So already you're in a loss of $2 for each lot you're carrying, and if you're going to average here, then if a price moves against you, then it's going to be a huge burden on you. You won't be having a sleepless night. So it's better you accept your loss here, and then the same way, if price goes in your favor, it's up to you whether you have to book profits in the middle, or you have to wait for a targets. It's up to you. If you are having many quantities, or if you are trading with multiple lots, what I suggest you is that The moment you take an entry, place your stop loss and exit off of your lots when you reach half of your targets. Maybe consider this as target 1, consider this as a target 2. If it's a $4 and $2 will be a target 1 and $4 will be a target 2. Mostly I won't prefer that, but for traders with multiple quantities, they won't be feeling much comfortable with um, placing. See, they have shorted here and the $2 has been reached here, but if you haven't they booked it, then they have to wait for a whole painful journey. Then again they have to wait here, again the price is started to going up, again it came down again, and finally they have to book. So from here, if they have booked here, then it will be easy for them to wait for another remaining lots to book at this region. So it will be easy for them. So for person who is having capability or who is having a capacity to take or to hold a position, then no worries for them. Either it's a stop loss or it's a target. And if you get a monthly one trades like this, then you can't be sitting daily in front of a chart. So you don't have to look for anything else. You just have to wait for 1 or 2 trades like this, take it, hold on for 4 to 5 weeks. That's more than enough. Yeah, it's a $4 rally. What more we do want? It's a easy money, right? It's any money on the table, unless and until, even if a stop loss is taken out, then you're going to get it. If you're going to do a reverse one, then you will get it. Or if you don't want to do a reverse one, you have to wait another for a range to formed. Anyhow, always price moves in a range. It's not like that it will break and it will again come down. Even if it breaks, then no problem. If it again is going to come down, then it will be still in the range. You can either short and you have to the same target as $2 and $4. Always your stop loss is going to be small and your profits is going to be very much big. So it's nearly 1:5 ratios. So I kindly advise you to follow these kind of setups and don't get trapped in between intraday's position. Intraday can take out your huge capital. If you increase the quantity, that's if you are trading 30 minutes, one bad position sizing can erase your whole capital. So I'm strictly against that, and I won't be supporting you to take that kind of risk. If you want to take that kind of risk, either it's better to take in a position, say for example, and it's a intraday. In intraday on 30 minutes so basis, you might have shorted here, placing stop loss here, and on a closing basis you might have booked this profit. So whenever price tries to come to this region, you can short and you have to hold. Whenever price come in this region, you have to short and hold it. We don't know whether it is actually going in your favor, it is not actually going against your favor. What we have to do is simply wait and we have to book. That's it. And if you are taking the same risk on positional trades, say for example, and you can hold for even much longer time frame, so we have to wait for a closing. If you're doing an intraday basis, and we have to square off a position on that day itself. So if you're doing positional with the same amount of risk, the target gets increased. So it's nearly a $2 targets, and this is $4 targets. It will be quite useful for you. Even if 1 or 2 trades goes wrong against you, but you will end up in the monthly profits, because the reward is that much bigger. So 1:5 ratios, you can take 5 hits in a row, and one hit in a good way or will make your trade or make your monthly profit cost to cost. So you don't have to worry about where price is going, how it's going. It's easy money is on the table. You just have to look for the range, you just have to play with your stop loss, you just have to control your human emotions. That is, psychology plays a major role. Once you are in trade, don't ever try to look your market. You have set your stop loss, you have set your target. That's it. You have to simply go and do some other work. You have to search for another stocks like this which has been trying to form a zones, and you can play with this. so it's a kind of a positional setup, and even it has a capacity. If you keep on doing the same thing and again and again and again in a repeated number of stocks, then it will be easy for us to create a fortune out of it. The one thing it will be very difficult for addictive traders is that they can't able to trade continuously. They have to wait for the setup to give a buy. Once it given a buy or once it given a sale, then either it's a target or a stop loss. Many people won't be preferring that. Some people will keep on trailing, and in between here trailing stop loss will get triggered and they will miss the whole move. So we should not be doing that. Our aim is that next zone is a aim, and stop loss is that the zone where we enter, the high or low should be a stop loss. So if you keep on doing that, you will get a mindset that you have to wait for a target. You don't have to book a small profits, you have to book only a bigger ones. Usually you will be avoiding big losses here, and you will be avoiding small profits here, and the only thing that you will be doing is small stop loss triggered big profits. So if you started doing this kind of mindset, and if you have built in the psychology that you are going to take a small hit and you are going to win big, then it will be easy for you to create a fortune out of it. This is the best way to do that, and I am following this, and I hope the small range play is going to help you in crude oil. And let's see how this coming week is going to be. I'm expecting the same is going to be a healthy resistance zone, and I don't think this is going to be taken out. And let's see, this is, I'm expecting this region to be taken out in a coming week, and we will be heading towards 36. Until 42 is safe, then 36 is on the cards. Thank you.